All right, let's dive straight into this explainer. Today, we're deconstructing a topic that literally alters the trajectory of growing enterprises. We're talking about U.S. business tax mechanics. More specifically, we're looking at the exact underlying structural mechanisms of how business owners actually pay themselves. You see, analytical models out there suggest that if your compensation structure isn't optimized, it systematically drains your capital. It turns proactive entrepreneurs into, well, reactive taxpayers. So we're skipping the generic, surface-level advice today. Instead, we're focusing entirely on the core mechanisms, the implicit assumptions, and the direct cause and effect relationships that dictate your true tax liability. If you want to understand this subject at a true expert level, well, the actionable insights start right here.
Here is exactly how we're going to break this down. First, pass-through income mechanics. Second, executing the owner's draw. Third, the self-employment tax trap. Fourth, the S corporation tax shift. Fifth, salary versus distribution. And finally, number 6, optimization and administrative costs.
All right, let's kick things off with Section 1, pass-through income mechanics. So to really optimize your capital retention, we first have to nail down the foundational mechanism of how business earnings are assessed under the tax code. There is a huge and honestly very expensive misconception out there. People think that just leaving capital sitting inside a business checking account somehow delays or even magically shields your tax liability. But the structural reality? All net profits are taxed in the exact year they are generated. The tax liability literally passes through the business entity directly onto your personal tax return. And this happens whether you transfer that money to your personal savings or just leave it sitting untouched in the corporate ledger.
Let me emphasize this point because it's absolutely crucial. The governing tax authority evaluates the mathematical net profit at the end of the year. Period. This renders the actual physical location of your funds completely irrelevant to your baseline tax burden. Think about it like this. If your entity generated, say, $100,000 in net profit, you are taxed on that $100,000, even if you didn't physically pay yourself a single dime of it. It's the math that matters here, not your physical account balance.
Moving right along to Section 2, executing the owner's draw. Okay, with that pass-through principle firmly established, let's analyze the actual mechanical procedure of moving your capital. How do you actually extract cash from a standard limited liability entity to yourself, the individual, without triggering massive compliance failures? Well, there's a strict operational sequence, and it is mathematically and legally uncompromisable. Step 1, you have to obtain your employer identification number. Step 2, open a strictly dedicated business bank account linked directly to that number. Step 3, execute the transfer of funds via a traceable method. We're talking a check or a wire. And Step 4, you must document the transfer as an owner's draw or distribution in your bookkeeping ledger. This right here is the only compliant mechanism for extracting cash for personal use. You cannot just skip steps.
Why is that sequence so important? Well, if you bypass that document and 4-step draw sequence, you trigger a direct cause and effect relationship known as co-mingling. Now, what is co-mingling? It's the administrative failure of mixing your personal and corporate funds together. Analytically speaking, this is a massive structural failure. It directly allows legal exposure to pierce the corporate veil. It completely nullifies the legal liability shielding that your entity was specifically designed to provide in the first place, and that results in a direct threat to your personal assets. So the separation between business and personal, it must be mechanical and it must be absolute.
Which brings us to Section 3, the self-employment tax trap.
Now we arrive at the core friction point of this whole system. As an owner, you're absorbing both the employer and the employee tax burdens simultaneously. Default business structures literally force you to absorb both sides of the employment transaction. This creates a mandatory 15.3% cumulative extraction. That breaks down to 12.4% for Social Security and 2.9% for Medicare. And remember, this is huge. This extraction is applied before your standard federal and state income taxes are even calculated.
But hold on, here is a really non-obvious analytical detail for you. Mathematical models show that this 15.3% tax doesn't apply to your gross revenue, and surprisingly, it doesn't even apply to 100% of your net profit. Instead, it's ruthlessly calculated against exactly 92.35% of the entity's net earnings. This highly precise multiplier is the exact base upon which your self-employment tax liability is engineered. So, what does this all mean? This compounding effect results in what analysts call the double hit. Because you're paying that 15.3% on top of your standard income taxes, you essentially enter a tax treadmill. It algorithmically penalizes scaling businesses. How? By systematically stripping away the exact working capital that was meant to be utilized for operational reinvestment and growth. It's tough, but it's the structural reality.
Let's look at a solution in Section 4, the S Corporation tax shift.
To legally bypass this mathematical trap, expert analysis points us to a highly specific structural optimization lever. See, in a default structure, essentially all of your net profit is subjected to that nasty self-employment tax. But by electing a specialized corporate tax status, often referred to as an S Corporation election, the owner effectively becomes an employee of their own business. This is a game changer. It fundamentally separates or bifurcates the income into two entirely distinct streams with completely different tax treatments. You get a controlled W-2 salary and a completely exempt distribution.
Let's break down exactly how that works in Section 5, salary versus distribution.
The true efficiency of this optimization engine relies entirely on the precision of the split. The mathematical division between the wage income you pay yourself and the corporate distributions you take is exactly what dictates your capital retention. Let's look at the data to prove this. If you have $100,000 in net profit in a default structure, you are paying over $14,000 just in self-employment tax. Ouch, right? But in the optimized structure, if you algorithmically cap your salary at, say, $30,000, only that $30,000 is subjected to the tax. The remaining $70,000 flows directly to you as a distribution, which is completely exempt from the 15.3% hit. Mechanically speaking, this physically retains over $9,500 in working capital for your business. That's real money staying in your pocket.
Now you might be thinking, great, I'll just set my salary to zero. Actually, scratch that. Do not do that. A critical assumption to avoid is thinking you can just artificially suppress your salary to nothing to maximize those exempt distributions. The tax code strictly mandates that the salary portion must be benchmarked against reasonable compensation metrics. This includes factors like your geographic location, your specific industry averages, your experience level, and the overall profitability of the business. Artificially suppressing your wage to avoid payroll taxes is a mechanism that will trigger immediate compliance audits. So be smart about the data you use to set that salary.
Finally, we need to talk about the costs in Section 6, optimization and administrative costs.
We absolutely must remain analytically objective here. Structural optimization, it is not free. Deploying this bifurcated structure requires specific maintenance frictions. What does that mean? Well, you're going to face annual franchise taxes or state fees, the cost of specialized corporate tax return filings, and the monthly overhead of third-party payroll processing software to manage your new W-2 salary. Analytically, you must model for an estimated $3,000 to $4,000 in annual operational overhead just to maintain strict compliance with this new structure. To put that into perspective, $50,000 in net profit is your analytical tipping point. This is an absolutely crucial takeaway. Below this $50,000 threshold, the structural friction costs, the payroll software, the extra tax returns, they actually exceed the mathematical tax savings. It's just not worth it. But once your net earnings scale past this $50,000 mark, the mathematical advantage overwhelmingly shifts in favor of the optimized corporate structure. That's when the magic happens.
Which brings us to our final, and frankly, most important thought today. Is your current compensation structure designed by strategy, or was it just inherited by default?
As your enterprise scales past that $50,000 optimization threshold, remaining in a default pass-through structure is no longer just an innocent administrative oversight. It's an active mathematical decision to literally forfeit your working capital. Analyze your numbers, understand these mechanisms, and ensure your structure is truly engineered for retention. Thanks for joining me for this analysis. I really hope this explainer has completely shifted how you view the hidden mechanics of business compensation. Catch you next time.